In my previous video, I talked about how a portion of the gain from the market index is allocated to your fixed indexed annuity by way of interest crediting methods established by insurance companies and include cap rates, participation rates, and or spread or margins. So today I'm going to talk about how the gain on the market index itself is computed. So there's two variables I want you to keep in mind. The first one is when. So what time period is used to compute the gain on the market index? And then I want you to consider how. So what method is used to compute the gain on the market index? So both of these are discussed in detail in the fixed indexed annuity contract. And you can see now why that fixed indexed annuity contract is so many pages. So let's get started in talking about how the gain on the market index is computed. By the end of this video, I'll give you the facts so that you can make an informed decision about whether a fixed indexed annuity is the right fit for your retirement portfolio. Hi, my name is Darlene Hartman. I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Let's start by talking about point to point. So point to point is from one point in time to the next point in time over a specified period of time defined in your fixed indexed annuity contract. Now it can be over a longer term, such as 2 to 7 years, to measure that point to point, or it could be month to month. Now, an interesting question may be raised if using the monthly point-to-point method. So let's assume that the cap rate on the monthly return is 2% as defined in the fixed indexed annuity contract. And you remember me talking about in the previous video that the floor is 0%. So does that mean you could earn up to 24% for the year, which is just 12 months times the 2% assumed rate in this example? Well, unfortunately, no. So if you're using a monthly point-to-point method, then the returns are capped at 2% for those months that the market index generates a positive return. But unfortunately, the negative returns are reported as is. So stated a little bit differently, you have a 2% cap on positive market index returns, but you have no downside protection with respect to those monthly returns. Now, when you sum up those 12 monthly returns to get the amount that's going to be allocated to your fixed indexed annuity, if it is a negative return for the year, then the 0% floor applies, which means that the value of your fixed indexed annuity will not change from the previous year, given the fact that the market index generated a negative return for the year. Now, what if a monthly averaging method was used to compute the amount of gain on the market index? So how that would happen is the first month would be based off the start date of the contract and then each month anniversary thereafter. And then you would sum up 12 months of those monthly returns and divide it by 12 in order to get an average monthly return. That average monthly return on the gain on the market index is then subject to the interest crediting methods that are defined in the fixed indexed annuity contract, and then that will result in the amount that is allocated to your fixed indexed annuity. Leave me a comment in the section below and let me know which of those methods do you think would be the most favorable for your fixed indexed annuity. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit that notification bell so that you can receive notices anytime I post a new video. Now, what I'm about to share with you is really important, and it's a big benefit of having a fixed indexed annuity over directly investing in a market index, and that would be annual resets. And they're even more important if we're in the midst of market downturns. So annual resets basically means that all of your gains from year to year are locked in each year. which means that the performance of the market index in successive years has no impact on the amount of gains that have been locked in on your fixed indexed annuity in previous years. So that means you're not going to have to deal with all that market volatility, especially in the years of market downturns. So to give you an example, if in the previous year you locked in a 6% return on your fixed indexed annuity, and the current year the performance of the market index is negative 2%. So that negative 2% will have no impact on the 6% return that you locked in the previous year. So don't forget about that 0% floor, which means that there will be no change in the balance of your fixed indexed annuity in that year of the negative market return. Also, don't forget, I've been talking about compounding interest for a deferred annuity. So just to remind you about how that works, if you put $100,000 into your fixed indexed annuity at the contract date and you locked in $6,000 in gains in the first year, your next year return will actually be computed on $106,000 rather than the $100,000 initially set up in the contract. In your fixed indexed annuity, there is the option for a fixed rate that is guaranteed over a specific term. That term follows in lines with the terms for the interest crediting methods, which again were the cap rate, the participation rate, and or the spread or margin, and can be changed at the discretion of the insurance company at each contract anniversary date. So that fixed rate is for those people who need the special features of a fixed indexed annuity, but don't want to be invested in market indexes. Now, I want to make sure that you understand that the fixed rate option in a fixed indexed annuity is different than the minimum guaranteed interest rate, which I'm about to discuss. If your market index options are not working out for you on your fixed indexed annuity during the surrender charge period, then the insurance company is going to pay you a minimum guaranteed interest rate, which is between 0 and 1%, given that we're in a historically low interest rate environment. That minimum guaranteed interest rate is paid to you at the end of the surrender charge period. So you remember me mentioning that the floor is 0%, which means the worst case scenario on those market index options for your fixed index annuity is 0, no gain allocated to the fixed index annuity. So what the insurance company has done is that they're willing to credit you a minimum guaranteed interest rate at the end of the surrender charge period. So just as a reminder, you are charged a surrender charge if you exit your fixed indexed annuity in the early years of the contract. If you're interested in obtaining a fixed indexed annuity in your retirement portfolio for the guaranteed income benefits that it can provide you, click the link below to apply to become my client. Also, if you enjoyed this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and share with your family and friends. Thank you for watching. Let's get the conversation started on how to live your best retirement while not outliving your money.